Hold on. Any other questions besides this one?
Counterparty.
Huh?
Counterparty.
Well, okay, counterparty and counterparty. Other questions? Other questions? Other questions? Okay, we'll turn it on. Is it on? Okay, so we're now lecture 9. Question was on counterparty risk, and call risk. Well, call risk is very simple. Bonds may have a call provision. And a call provision simply says that the issuer can call the bond. And calling the bond means that instead of paying you for the next 7 or 8 years, this year he gets all the money and pays you back the money, and we say retires the bonds. So instead of you collecting for the second, third, fourth, fifth, sixth, seventh, 8th year, 8% per year, at year 3, he can call the bond, pay back the money, and now instead of you collecting 8% interest, you run the risk when he pays you back, you're not going to be able to reinvest again at 8%. So call risk translates into reinvestment risk. Now, in a reinvestment risk, you get the coupon. And you have to reinvest the coupon. And you might not be able to reinvest the coupon at the same rate. In a call risk, you have to reinvest not only the coupon, but the principal too. In other words, the whole bond. Okay? So on the reinvestment risk, you risk only lower return on the coupon, or the coupon and part of the principal. Here, you risk everything. You risk lower return on not only the coupon, but the principal too. So, in many ways, call risk is similar to reinvestment risk. So, it is reinvestment risk on both coupon and the principal at the same time. And the other one was counterparty. Okay, first of all, let's explain what is counterparty. Simply means that whenever you have a transaction, there are always two, maybe more than two parties in a transaction. But you can't transact with yourself. You can't do a transaction by yourself. It's company A with company B, a company A with a bank B, or between two banks. Sometimes you may have 3 or 4 parties in a transaction. So, counterparty is another party, a different party in a transaction. And the other party usually assumes some obligation, some responsibility. Well, counterparty risk basically means that when the time comes for them to perform their obligation or on their obligation, they're unable to perform or unwilling to perform, or in the worst case, don't exist to perform, meaning that they're already bankrupt. Okay? So a basic counterparty risk happens extremely commonly in the field of insurance. And in insurance, the insurer usually acts as a counterparty. And the insurer, for example, insured a whole bunch of houses all over Florida. Okay? And then comes Katrina, hits all the houses, and they say, oh my God, we insured 10 million houses, And in 10 million houses, if we have 1,000 we can pay, if we got 10,000 we can pay, even if we have 50,000 we can pay. But with Katrina, we got 1 million houses damaged, and on 1 million houses we can't pay on all of them. We are bankrupt. Okay? So they made a promise, but somehow the event is so large that the insurer itself got bankrupt in the process. Okay? Well, of course, they have reinsurance so that they don't bankrupt themselves, but you can get in trouble that the reinsurer himself gets bankrupt. Okay? So that's a counterparty risk. Another counterparty risk which will be coming soon is, for example, Fannie Mae and Freddie Mac, they issue bonds, they provide guarantees, and everybody is thinking or understanding that maybe the government will insure them, meaning if they get in trouble, the government will bail them out. Maybe not. Well, what happened during the crisis in 2008, as we're studying in our other course, is that Fannie Mae and Freddie Mac actually could not perform on their obligations. Okay, they couldn't pay on their bonds. So Fannie Mae and Freddie Mac effectively got bankrupt themselves. So that's a second example of going bankrupt, and you were expecting them to do something for you, but they're already bankrupt. Now, in their case, the government had to step in and bail them out, meaning the government assumed their responsibilities. Okay? So that's counterparty risk. The risk that the other party in a transaction cannot fulfill its obligation. Usually because it's already bankrupt. Usually because it's already bankrupt. Is that fairly clear? All right, any more questions before I get back to the textbook? Any questions? No? All right, so now we are in chapter 3. Chapter 3, section 4 is page 49, total return. And that's on page 49. All right, so what do we have a total return? Oh, okay. It is a measure of return which also incorporates reinvestment risk. So you're simply not saying, okay, what's going to be my return? But you're saying, what's going to be my return if we assume a certain reinvestment rate and certain reinvestment risk. So in all the previous measures, you don't make assumption about the reinvestment rate and respectively the reinvestment risk. In this particular case, you assume what's the reinvestment rate. That's the basic difference. Well, if you're going to have a total return, the next piece that you need is called investment horizon. Investment horizon is a fundamental concept in portfolio management. And in portfolio management, you have an investment horizon. In general, in investments, you have an investment horizon. This is a period of time for which you expect not to need the money from the investment, and you can keep the investment as an investment. Okay? Examples, right? Examples. You got parents, okay, you got parents, you got a 10-year-old brother, and your 10-year-old brother, your parents expect him to go to college at the age of 18. And they expect to finance his university tuition and fees with an investment. In this particular case, in this example, the investment horizon is 8 years. From the age of 10, which is currently the son, to the age of 18, you expect not to use the money. And you expect to keep the investment for 8 years. When he turns 18, you will actually take the money and pay tuition. Okay? Well, now it could be a slightly different version. Slightly different version will be the following. They save $100,000 now. And they have $100,000 to finance college. Okay? He's 10 years old. And then they're going to say $25,000. The investment horizon is 8 years. Well, for the next $25,000 of the current proceeds of the current investment, you'd expect to invest 9 years. In other words, when the student goes to college for 4 years, you don't expect to get all the money and throw them in the first year. You're going to use 25 for the first year in college. So this is the age of 18. This is for the age of 19. 25,000 is going to be 10 years from now. And 25,000 is going to be 11 years from now. This is at the age of 20 and at the age of 21. So basically, your investment horizon is, we can say, between 8 and 11 years. Or a quarter of it is for 8, a quarter of it is for 9 years, for 10 years, and for 11 years. Okay, well, that's investment horizon. Now, let's try a different investment horizon. Investment horizon for me, right now being the age of 42 and expecting maybe to retire at the age of 60. If I want to retire at the age of 60, this means that whatever I earn, save, and invest, I would supposedly not need for the next 18 years for my retirement. So my investment horizon is 18 years and over. Okay, so that's my investment horizon. So what's investment horizon having to do with bonds? Well, it's very simple. When you want to invest in bonds, you want to invest and maximize the total return over the investment horizon. So it's no good today to get a great return for the first year if for the next 9 years you're going to be getting very, very low return. You might as well invest in such a way that for all 8 years you lock in a good high return. And that's what investment horizon is doing. And in your particular case, total return will say the following. Do I want to invest in a 10-year bond, or I want to invest here in a 5-year bond and then reinvest in 1-year bond? That already makes 6 years, and then reinvest in 2-year bond. Okay? Well, that will depend on the reinvestment rate. If I expect reinvestment rates to be higher, I'll be having somewhat shorter periods here. The opposite. If I expect the reinvestment rate to be lower, I will be investing directly in 10-year bonds. And I'll lock in my return today. Okay? And then there is that other question of, okay, well, if I'm investing for 10 years, if I'm going to be getting coupons, do I want to have a high coupon or a low coupon? And the answer is, I want a low coupon so as to minimize the reinvestment risk. So, investment horizon tells you what is the overall period for which you want to invest, and the reinvestment rate will suggest to you, do you want to invest in a relatively short period and expect a better return when you reinvest later? Or the opposite, you will just invest for a whole period and then lock in your return. Now, you may do something else. You may want to do, for example, if it's a 10-year investment, you may actually invest in a 20-year bond. And if you invest in a 20-year bond, you hold the investment for 10 years, and at the end of 10 years, you sell the bond. And then, if you sell the bond, you're going to see, what's going to happen then? You say, well, what if you expect for some reason that interest rates will go down a little bit? If they're going to be going down somewhat, what you want to do is buy a 20-year bond. And even though you're going to be reinvesting at a lower rate, the price of your bond is going to be going up. If interest rates go down, and you expect interest rates to go down, you expect the value of your bond to go up. So after 10 years, you're going to realize a capital gain on your bond. So the key to total return is, what do you expect to be future interest rates? So it depends on number one, investment horizon. Number two, it depends on future yield or future interest rates. So, do you expect to be reinvesting at higher future interest rates or lower future interest rates? And finally, you will also see the required rate of return at the end of the period. At the end of the period, do we expect 10 years from now much lower interest rates, or much higher interest rates, or the same interest rates? You need the required rate of return at the end of the period in case you invest in longer term bonds, like 20 or 30-year bond, and you want to know 10 years from now when you're selling it, do you expect to sell it at a higher price or at a lower price? Okay? So you need these three pieces, and then based on these three pieces, and of course the current yields, you determine the total return. Basically, the future interest rate will tell you the reinvestments. And the required return will tell you if you're going to have any capital gains or capital losses at the end of the period. Okay? Total return, okay, investment horizon. In the textbook, they use for the last one, which I call required rate of return, they call projected required yield. So this is projected, meaning what you expect it to be the future required yield. But of course, required yield is exactly the same as required return. So this is basically the expected rate of return. Expected rate of return. The expected future yield. Okay, now they have on page 50 all the way to 53 a calculation. So, example. Is from page 50 to 53, which you're going to look on your own. So 51, 52, they show you the steps. It's everything what I explained so far. And they have an example with numbers on page 52 and 53. What I'll do is basically move on to section 5. And section 5 is on page 54. Oh, okay. Horizon analysis. horizon analysis is actually what is studied in every management course and what is done everywhere in management and sometimes in finance, which we call sensitivity analysis. Sensitivity analysis. So, what is sensitivity analysis? It's very simple. You have a model, and a model will have input, what you put into the model, and you have an output. And here, you have a model. So, what's the output? The output in sensitivity analysis, actually in horizon analysis, is what I've been explaining for the last 10 or 15 minutes, which is the total return. Total return. So, output, I write in our case, total return. And what we simply do is very simple. We say, what if the required rate of return at the end of the period changes from 8 to 10%, or from 8 to 6%? So you begin to change the input, and then you recalculate the total return. And basically you find out how sensitive your investments are to changes in the input. Well, what's the input? These are current interest rates, expected future interest rates, meaning the expected reinvestment rate, and the required rate at the end of the investment horizon. Basically, we call this the economic or the interest rate environment. Now, why you want to do this sensitivity analysis? It's very simple. You determine risk. You change a little bit the reinvestment rate, you see what's going to be your total return. You change again the final interest rate, you see again what's going to be your total return. So, for each type of interest rate environment, you're going to be getting a different total return. And that will be basically telling you, based on different investments, which would perform best. Alright? So, let's try to do this. I'm not going to provide a complete example, I'm just going to give you. You have investment A. This is bond A. B is going to be some other investment. Maybe invest for 5 years plus another 5 years. C is going to be investing, let's say, in 3 years plus 5 years plus 2 years. I don't know. And D is going to be investing in 20 years. Okay. And then, based on these investments, you assume, for example, that they're going to be relatively higher interest rate. So, you compute the total return for A. You get the total return for A. So it's going to be total return for A when the interest rates will be high and rising. You're going to be also doing the total return for B when interest rates are high and rising. You're going to be doing total return for C if interest rates are high and rising. And then you're going to determine the total return for D if interest rates are high and rising. Basically, you're going to be comparing, if I'm going to be investing for 8 years, which total return is the best? Is it for investment A, for investment B, for investment C, for investment D? And the answer might be, oh, it's going to be for C. But now the question is, oh, what's going to happen if interest rates by any chance aren't high and rising? What if interest rates are low and remain low? So you compute now total return when you have, for A, when you have a low interest rate environment. Then you compute the total return for B when you have a low interest rate environment. Then you compute again total return for C at low, total return at D for low. And now the question becomes, is C still delivering the best return if you have a low interest rate environment? Or maybe it is B. Maybe it is B. Maybe B will provide a much better return. Okay. So now you're saying, well, total return here was 9%, and total return here was 2%. Here, total return was 7%, and here, total return was 8%. Well, which one is better? From 9, you risk falling down to 2, or for 7, you actually can improve to 8. And the answer is intuitive. Again, you don't need a PhD in finance to say, oh, I'd rather take 7 instead of 9, and if things go to lower interest rate environment, I'm going to actually improve from 7 to 8 and do much better, instead of taking a huge risk of falling my return down to 2%. Okay? So here is one obvious answer when a lot of investors will say, I'll choose 7 but take a low risk. Now, what about the following environment? What about from 7, this one falls down to 6? Well, what is it you do? Are you going to choose 9 with a risk of falling down to 2, or going to choose 7 with a risk of falling down to 6? Well, B. Okay, so 7 with a falling down to 6. Well, the answer is intuitively, it is better to choose 7 falling down to 6, but it depends on the risk preferences of the investor. Some investors will be greedy and they'll want the return and wouldn't care about the risk. When they invest your money, they will choose 9, because if they get 2, it's not they get 2, you get the 2. You understand?
So it's moral hazard.
Huh?
Moral hazard.
Yes, moral hazard will be one perfect example of why many fund managers will choose 9 and risk going down to 2, because they risk your money, not their own. If you manage your own money and you're conservative, you're going to choose 7 going down to 6. Again, the answer is it depends on the investor's preferences. It depends on the component of moral hazard. Are you investing your own money? Are you investing your money for yourself, or for your child, or for your brother, or for your boss that you hate? Or you're investing the money for some general investors. And if you're investing it for other people, how is your bonus structured at the end of the year? If at the end of the year you're going to get a very high bonus if you deliver a high return this year, they say, oh, I'm going to take 9, which is a very high return. I'm going to get a high bonus and screw them 5 years from now. It doesn't matter what happens. Well, if they lose the money, that's okay. It's their money, not my money. For me, my bonus is in my pocket. Okay? So, that's important to understand, that moral hazard in this environment can provide the answer which is totally different from what the investor would choose for himself. Okay? And some investors would say, oh, I definitely need 9%. Okay, it's actually what's happening in these days is the following. So many investors have lost so much money and they need so much higher return to retire, let's say 10 years from now, that they say, I can't take 7. I gotta take 9, and I gotta take the risk because I need 9 to retire. And I got no second chance. I'm 50 years old, I'm retired 10 years from now, I got very little saved, I gotta take the risk and take the 9 and hope that I will actually get 9 when I retire, okay? So, it depends on the references, meaning risk preferences. Is that fairly clear? Well, that's basically sensitivity analysis. And the sensitivity analysis tells you how your returns are sensitive in changes to interest rate. Here, they're little sensitive. From 7, the change is barely 6. Here, they're very sensitive. From 9, it falls all the way down to 2. Little sensitivity means little risk. High sensitivity means very high risk. Is that fairly clear? Okay, and now we have calculating yield changes, which is number 7, page 54. Okay, horizon analysis is page, again, 54. And here we got 6 yield changes. Well, changes in yield are done or measured in 2 ways. The first one is called absolute. And this is a way that everybody understands. It's easy, it's simple, it's straightforward. Interest rates went up from 3 to 4%. And in this particular case, we simply said that interest rates are up 1%. That's it. It's a simple difference. Usually in bonds and in bond markets, the difference is expressed in basis points. Okay? And in basis points, 1% interest is just the definition of a basis point, is 100 basis points. 1% is 100 basis points. So in this particular case, as an example, we say that interest rates increased from 3 to 4. The increase is 100 basis points. If interest rates went up from 4 to 6.5%, if that's the change from 4 to 6.5%, the increase is 250 basis points. Okay? That's fairly easy and straightforward. And the other one is percentage yield. We just call it relative, but in the textbook they use page 55, percentage yield change. Percentage yield change. Percentage they have here some natural logs which are very confusing, but it's fairly simple. From 4% to 5%, the increase is basically 25%. 25%. In other words, you have a 1% increase on a basis of 4%, so 1 out of 4 is 25. If you got 4% going up to 6%, this is the same as 50% increase. 50% increase. Okay? That's what it is. 50% increase. And if interest rates go up from 1% to 2%, it's 100% increase. Okay? That's basic elementary math. So from 1% to 2% is 100% increase. In other words, interest rates doubled. From 2% to 4% it is 200 basis points, or the same as 100% increase. From 2 to 4, when interest rates double, the relative yield or percentage yield change is 100%. When interest rates triple, the relative yield change is 200%. All right, is it time for a break, or we want to continue with chapter 4? Take a break now? Want to take a break? All right, so we're done. Take a break.